All right, welcome to The Explainer. Today, we are diving deep into a really interesting argument about the U.S. national debt and what it could mean for assets like Bitcoin. We're pulling this analysis straight from the folks over at the YouTube channel Altcoin Daily. And you know what? We're going to kick things off with a pretty serious warning. This comes directly from the top, Fed Chair Jerome Powell himself. And this one quote, well, it pretty much sets the stage for everything we're about to get into. So what's behind a warning like that? What's got the head of the central bank so concerned? Okay, let's really dig in. Now, Powell says the issue isn't just the size of the debt today. It's what he calls its unsustainable path. And what does that actually mean? Well, think of it this way. Our national credit card bill is racking up charges way, way faster than our national paycheck is growing. It's a simple but pretty scary mismatch. All right, so let's put some numbers to this. When you actually see the data behind this unsustainable path, that's when it all starts to click. And honestly, it becomes crystal clear. So check this out. The source we're looking at points out that the U.S. national debt just blew past a mind-boggling figure, $39 trillion. And yeah, that's for the first time ever. And this chart right here, man, it just lays it all out. This is exactly what Powell was talking about. You've got the debt just shooting upwards, right? But look at the economy, the GDP that's supposed to pay for all that. It's growing, sure, but way slower. That gap between the two lines, that's the unsustainable path in a nutshell. Okay, so this is where the raw math gets kind of crazy. The U.S. owes $39 trillion. But how much does it bring in each year from taxes? Only about $5 trillion. So the source's point is pretty stark. Trying to pay off that massive debt with that much income, it's just not possible. The numbers simply don't add up. So because of that mass, the source argues that the government and the Fed are basically caught between a rock and a hard place. There are no easy outs here. It's a really tough dilemma. You know, if you look back through history, there are usually two ways to handle a debt problem this big. Option one is you just grow your way out of it. You make the economy so huge that the debt, by comparison, starts to look manageable. Option two, you got to start cutting. And I mean major cuts to big programs like Social Security or government health care. But here's the million-dollar question the source brings up, the real wrench in the works. What if the economy doesn't grow? What if it actually shrinks and we head into a recession? Well, it's like a domino effect, right? When a recession hits, businesses and people earn less money. And when they earn less, they pay less in taxes. So that means the government's income goes down, making that debt problem, well, a whole lot worse. The hole just keeps getting deeper. And this all leads to the Fed's huge dilemma. See, they could hike interest rates to fight off inflation, but think about it. With $39 trillion in debt, even a small rate hike means the interest payments on that debt would absolutely skyrocket, basically crippling the entire federal budget. So the source argues their hands are tied. The only real option left on the table is to cut rates to stimulate the economy and avoid that debt spiral. Okay, so let's say the economy starts to slow down, and we've already established that hiking rates is probably not going to happen. So what's next? Well, according to this analysis, you just have to look at recent history. The pattern is pretty darn clear. Yeah, just look at the playbook. Back in 2008, during the financial crisis, what did the Fed do? They slashed interest rates and fired up the money printers. Fast forward to 2020 and the pandemic crisis, what happened? The exact same thing. So the argument here is that the next time we hit a major economic slowdown, they're going to be forced to do it all over again. It's the only move they have left. All right, so this is the crucial part. If this theory is right, and the Fed is forced to create trillions and trillions of new dollars, where does all that new money actually go? And that's exactly where we connect the dots to crypto. So the central idea, the core of this whole argument is this. When you inject trillions of new dollars into the system, that money doesn't just disappear. It has to flow somewhere. And it tends to chase after scarce assets, things that have a limited supply, things you can't just print more of. And what's the ultimate example of that? Bitcoin. And this leads to a pretty specific outlook from the source. For Bitcoin, the long-term prediction is that it will just explode in value when the next wave of stimulus hits. But there's a catch for the short term. They're pointing to a technical pattern called a bear flag, which could mean we see another price dip before that big rise. Then there's Ethereum. They're also really bullish on ETH, but for a different reason. The massive growth of stablecoins, which are basically digital dollars. And guess what? Most of them are built on Ethereum. And, that bullish case for Ethereum isn't just coming from crypto enthusiasts. It's being backed up by people like a former U.S. Treasury Secretary. The argument is that stablecoins, these digital dollars, are a massive innovation. And because the vast majority of them run on Ethereum, they could actually strengthen the US dollar's role in the world, which would, of course, drive a ton of value to the network they're built on. So, when you boil it all down, the takeaway from this analysis is pretty profound. We could be heading into a future where massive stimulus isn't just possible, it's necessary. And that could fundamentally change what we think of as value. Which leaves us with one final huge question. If the source is right, and trillions more dollars are about to be printed, where is all that money going to go?